Having a high FICO score can be exceptionally misleading. If you listen to the mainstream media, if you look at social media, if you listen to marketing, they'll tell you once you hit a 760, 800 plus and above, the sky opens up and you can't be denied for anything. And to be honest, nothing is further from the truth. I want to give you context on why having a high FICO score in itself is not enough to minimize denials, maximize limits, and maximize the best rates and terms on anything you borrow for. I also want to give you context on why your credit profile is actually exceptionally more important than your credit score itself. And I want to give you context of the two major lenses that every single lender and creditor is looking at you through when you put in an application for one of their products. I want to give you that context in this video. Before we get into that any further, I want to give you context on who you're getting this information from. My name is James Phillips. I'm a 13-year veteran in banking and financial services industry. I currently work a corporate job for a major financial institution where I help small business owners and consumers with all of their banking needs, their lending needs, cash flow management, etc. I have an active mortgage license. I have an active life insurance license. I have an active FINRA Series 6 investment license. I have a small business banking certification, and the list goes on. So I've been doing this for quite some time, and I've been doing this at one of the highest levels for quite some time, helping clients from working class everyday people, so those with 6 and 7 figures and even 8 figures in net worth, 6, 7, and 8 figures in revenue when it comes to businesses. So you're getting this information from somebody who has real hands-on experience with thousands of clients. I emphasize thousands. Now, that having been said, the big myth or misleading concept behind a high FICO score, number one, is going to be the fact that you can accomplish a really high FICO score with very little data on your credit report. Within a couple trade lines on your credit report, for any of you who might be new and don't understand what that means, a trade line is any active or closed account that's reporting on your credit report. It's referred to as trade lines in the credit world. Having a couple to a few of those in 1 to 2 years time, if you manage them properly, it can be a couple credit cards, or it can be one credit card and an auto loan, whatever the case may be. You can accomplish a 720, 740, and potentially even a 760 FICO score that easily if you maintain those accounts in just a couple years time. It's not hard to get a high FICO score, and this is why for many lenders and creditors, this is not enough to qualify you at all for a product or to qualify you on the highest limits or the best rates and terms on a product, because you're not giving enough data on your credit report on that application for that lender to feel comfortable to give you the best that they have to offer. So why is the credit profile more important? Well, I just gave an example of that, or leaned in on that, when I expressed how you can accomplish a high FICO score with a very thin credit profile. Your FICO score is going to just be one of those litmus tests or that bar to qualify you for the conversation or assessment at all. If you have too low of a FICO score, you could have 1,000 trade lines on. A bank's not even going to entertain it. There are going to be these thresholds that lenders, especially for traditional lenders and mainstream brick and mortar banks and institutions who are still leaning on your FICO scores to qualify you for products, they are going to have a threshold of who they are looking to approve. If you're below a certain threshold on a given product, they're not even going to entertain it. It doesn't matter how much data is on your credit report. So your credit score is more of just kind of a conversation starter. It's like, okay, this person meets this initial threshold, and it's also used to determine how much you pay on that given product as far as interest is concerned. Credit scores are oftentimes tabled off in ways to help determine what they're going to charge you based on your risk level, which that brings me to my next point in the two lenses that you're looked at when assessing your application: how low risk you are and how profitable you could be. These are the two major things that every single financial institution is looking at you, or the lenses they're looking at you through when assessing your application. And this is why your credit profile needs to paint a pretty picture. You can't just go to, apply for a high-end credit card or a high-ticket item like a mortgage, etc., a really expensive car, extremely paper-thin credit profile, because even though your FICO score might be a 760 or above, there's not enough data to gauge you through those two lenses and see that you're going to be low risk and that you're going to be profitable. You might get approved for certain products still, but it's not going to be anywhere near what you could get if somebody with that same 760 plus had a much thicker and much more robust credit profile. So we're going to quickly run through, by FICO's own admission, their own data, what it looks like per metric to qualify as basically the lowest risk and a good indicator of how profitable you're going to be. We're going to look at this through the eyes of FICO first by gauging the 5 major metrics that your credit report is composed of in the first place. Most of you already know that's going to be payment history, amount of debt, length of credit history, amount of credit, and credit mix. When it comes to FICO, at least, Vantage is a little bit different. So when we look at payment history, the first thing out of the gate we'll notice with payment history is 98% of FICO high achievers have no missed payments. So that tells you out of the gate, minus a couple anomalies, that you can't have any missed payments if you want to be the lowest risk and the highest profitability in the eyes of a lender. The next one we're going to look at is a few different sections within amount of debt, or this is going to be the utilization category. So revolving utilization, the threshold is 7% or less for FICO high achievers. So that means, again, this is going to be one of those areas where you want to look the most appealing to lenders. If you want to look the most appealing in the eyes of creditors, you need to be at somewhere around a 7% threshold or less to be, again, the most attractive. Accounts with balances. This is one that's under the radar. It's not talked about very much, but it is something that is counted directly into your credit profile under the utilization category. For FICO high achievers, 3 accounts carrying a balance. That basically means that there's not a ton of different accounts in the revolving open-end category, by the way, carrying a balance, as well as potentially going to be any installment history as well falling in that bracket. When we start talking about total balances on revolving and open-end accounts, that means some type of revolving product. Think credit cards, charge cards, and department cards as an example. FICO high achievers have less than $2,500 owed on those accounts combined. Again, $2,500 or less to be pristine in that particular area of the utilization category. When we start looking at length of credit, 9 years plus is the average age of accounts for FICO high achievers. This again is going to be where you're going to be the most attractive in this particular area. When we start looking at age of oldest account, it's 25 years or older. So for those of you who are in my type of age bracket where I haven't even had credit for 25 years yet, that's something for us to work up towards, but that's the threshold to be a FICO high achiever. And again, where lenders and creditors are going to look at you and say, okay, this is somebody that we can rely on to likely be low risk and highly profitable. Amount of new credit, age of most recently opened account. This is going to be 2.7 years on average for FICO high achievers, basically meaning that they haven't opened a new account in about that window of time, a little over 2.5 years. So there's not a ton of, there's great gardening in this. This is a better example of gardening because it doesn't mean that they're not getting new accounts over time. But FICO high achievers tend to space out how often they get accounts. If you're new to the credit and finance space here on the internet, gardening is a term to describe breaks between new accounts before your next round of funding or round of applications for other credit and other lending products. When we start talking about recent inquiries, this is another one where 70% of FICO high achievers do not apply for credit in the past year. So that means that it kind of ties into that age bracket on how long between accounts. They're usually 2.5 years plus. So that obviously means that they're not going to have recent inquiries in the past 12 months, which for FICO, 12 months is about the radar that they count inquiries on your credit report. After about a year, they stop counting into your credit score as a factor. They're still reported up to 2 years, but they stop affecting your score after 1. So when we start getting down to the last bracket, that's going to be credit mix, and there's several subcategories here. So revolving accounts, the average FICO high achiever has 11 revolving accounts. That is a ton of credit for those of you who may not be as familiar or your credit profile is thin and you may be wondering what it's going to take to have a robust enough credit profile. Just revolving alone, 11 is the magic number or above for FICO high achievers. When you start looking at installment loans, including mortgages, there's 5 or more of those for the average FICO high achiever. Another game changer, because now you're thinking, well, how many mortgages or auto loans or installment loans? You can also count student loans in this category, personal loans, recreational loans, auto loans, and mortgages. 5 or more installment loans to be a FICO high achiever. Bank issue credit card accounts. This is where the whole fintech movement can be a little misleading as well, because these oftentimes are not actual quality full-scale banking institutions. They're fintech or financial technology companies that are sometimes backed by real institutions, but not themselves primary institutions. And FICO high achievers have an average of 6 cards bank issued on average. So that basically means that you can't go fintech crazy. You have to have verified quality financial institution, brick and mortar institutions. You need to have good accounts with those institutions, reporting on your credit report to be the most appealing. That breaks out all 5 scores that we're measured by. So when we break this conversation down further, let's think about the specific needs that a financial institution is going to have, or the requirements, or what they're looking for in their applicants. This starts to vary institution by institution, and this is why it's important. And I took the time out to go over what FICO is counting as high achievers, or their most high-ranking, low-risk, most profitable borrowers with the healthiest financial behavior. Because at the end of the day, if you look at the different institutions, they're all going to have their own threshold for what they consider sensitive points when looking at your application. So what does that break down to? What's some good examples? Chase's 524 rule. Chase is very new account, very new inquiry sensitive. Very. If you are over a certain threshold of new accounts or been applying for too many different accounts, whether approved or denied, Chase Bank is going to be very skittish on doing business with you in the lending department. American Express is an example of an institution that is not. American Express, you can come in with 3, 4, or 5 new accounts or 3, 4, or 5 inquiries in the last 6 months and still have a shot at getting approved with American Express, especially if you have an existing credit card relationship with them. That's just 2 quick examples. Navy Federal has their own threshold that they're typically a little bit of bankruptcy friendly, etc. And when it comes to negative items on your credit report, they tend to be a little bit more lenient. They may have other sensitivity levels. These are just quick examples. So you want to follow the threshold, the path that's already been paved when it comes to your FICO score. What I laid out on FICO High Achievers, which many of you can find on your own, hopefully your got credit monitoring apps, you can look this information up yourself and see where you fall on your credit report. You have Credit Karma, that's another good resource. I know Credit Karma gets a bad rap for its Vantage scores, but at the end of the day, that data is pretty synonymous with FICO and what they consider quality credit and quality borrowers. So you can compare your information and say, okay, these are the areas I'm strong, these are the areas I'm weak. And even though I may have a 740, 760 plus FICO score, I may be still putting myself at risk of getting denied or not getting the best rates and terms or the highest limits with other lenders because I have poor sections of my utilization, I have poor credit mix, etc. This is very important for you to be educated, because then when you go into the weeds of the particular financial institution that you're looking to do business with, now you have to get into their particular sensitivities, or AKA their appetite for lending based on their profile and who they want to lend to and who they consider lower risk based on their business model and who they consider profitable based on their business model. That's going to vary from a credit union to a small bank, from a small bank to a regional bank, from a regional bank to a large lender, from a large lender with a brick and mortar to an American Express with no branches. That's all going to vary. The goal is to understand what you need to look like in the eyes of an underwriter, in the eyes of the algorithm underwriting you. And this is what this video is all about. Comment down below. Let me know where you stand when it comes to your FICO scores and your credit profile. The metrics that I read out to you in this video, how do you stand with them? Where are your weak points and where are you strong at? Do you have examples of having a good credit score and still getting denied for something, or a thin limit or bad terms on a particular lending product? Comment it down below just to kind of drive this point home. I want you to leave any additional thoughts and questions in the comment section below. To all my pioneers, welcome back. To my new viewers, welcome in. I want you guys to support this channel by commenting, sharing, or subscribing, so this channel can keep supporting you by putting out quality content to help you advance your personal and small business finances. To all my pioneers, thank you again. To my new viewers, hopefully you'll subscribe and become one of the pioneers on this channel and this committed, this community. And other than that, I want each of you to stay focused, stay in motion. I'll see y'all soon.